What sets Warren Buffett apart? No gold in his portfolio. Investor extraordinaire Warren Buffett is one of the most successful investors of all time. Yet one thing sets him apart from many other investors. He doesn't hold any gold in his portfolio. While gold is often seen as a safe haven asset, Buffett has stayed away from investing in the precious metal over the years. In this video, we'll take a closer look at why the Oracle of Omaha shuns gold and how it contributes to his overall success. The history of gold. Gold has been a coveted metal for centuries, valued for its beauty and rarity. It has been used as currency, a symbol of wealth, and even as a material for religious objects. Throughout history, gold has been discovered and mined in various parts of the world, including Egypt, Rome, and South America. During the early 20th century, the gold standard was implemented, which linked currencies to the value of gold. This standard allowed for more stable exchange rates and helped to prevent inflation. However, the gold standard was abandoned in the 1970s, leading to a more volatile gold market. Today, gold is still a popular investment asset, particularly during times of economic uncertainty. Its value tends to increase during periods of inflation, deflation, and geopolitical instability. Despite this, not all investors choose to hold gold in their portfolios, including the legendary Warren Buffett. So, why does Buffett avoid investing in gold? The role of gold in an investment portfolio. Gold has been regarded as a store of value for centuries and has played an important role in financial systems throughout history. It is often viewed as a hedge against inflation and a safe haven in times of economic uncertainty. For many investors, gold has become an essential component of their investment portfolio. Some financial advisors recommend allocating 5 to 10% of one's portfolio to gold to diversify risk and balance out other asset classes, such as stocks and bonds. However, the role of gold in an investment portfolio is debatable. While it is true that gold has often outperformed other asset classes during times of market volatility, it is not a guaranteed safe investment. Its value is based on supply and demand and can fluctuate rapidly. Additionally, gold does not provide any income or earnings potential. Unlike stocks or bonds, there are no dividends or interest payments to be earned from holding gold. This means that gold may not provide long-term returns as compared to other investments that generate income and earnings over time. Overall, the role of gold in an investment portfolio is dependent on individual investment goals, risk tolerance, and market conditions. While it may be tempting to follow the trend and invest in gold, it is important to consider all aspects of its value and role in a diversified portfolio. Warren Buffett, known for his successful long-term investments in companies like Coca-Cola and American Express, does not hold gold in his portfolio. He believes that investments in productive assets like businesses provide better long-term returns than investments in non-productive assets like gold. In his words, gold is a non-productive asset. It doesn't produce anything. While Buffett's investment strategy may not work for everyone, it highlights the importance of evaluating all aspects of an investment before adding it to a portfolio. In the case of gold, it may provide short-term benefits, but may not be the best option for long-term investments that generate income and earnings over time. Why Warren Buffett doesn't invest in gold? Warren Buffett is widely known for his investment strategy and the success he has achieved through it. However, what sets him apart from many other successful investors is his approach to investing in gold, or rather, his lack thereof. Despite the historical importance of gold as a store of value and a safe haven asset, Buffett has made it clear that he does not hold any gold in his portfolio. In fact, he has often been quoted as saying that gold has no productive value and is not an investment but a speculation. There are a few reasons why Buffett avoids investing in gold. Firstly, he believes that gold does not generate any cash flow or earnings. Unlike stocks or bonds, gold does not pay dividends or interest, making it less attractive for long-term investors like him. Additionally, the price of gold is driven primarily by supply and demand factors, which are often subject to geopolitical or economic events that are difficult to predict and control. Furthermore, Buffett sees gold as a non-productive asset that doesn't contribute to economic growth. While he acknowledges that gold can serve as a hedge against inflation or currency devaluation, he argues that other assets like stocks or real estate can offer better long-term returns by providing growth and earnings potential. It's worth noting that Buffett's perspective on gold is not universally shared, and many investors consider gold to be a valuable diversification tool and a safe haven asset during times of economic uncertainty. However, Buffett's investment strategy has proven to be successful over the long term, and his decision to avoid gold in his portfolio is consistent with his overall approach to investing. In summary, while gold may have a role in some investment portfolios, Warren Buffett chooses to stay away from it. He views gold as a non-productive asset that does not generate any cash flow or earnings, making it less attractive for long-term investors like him. By focusing on productive assets with growth and earnings potential, Buffett has built a successful investment portfolio that has stood the test of time. The advantages and disadvantages of investing in gold. While gold has been a popular investment for centuries, it's important to understand the advantages and disadvantages of adding it to your portfolio. Advantages: 1. Hedge against inflation. Gold can act as a hedge against inflation, as its value tends to rise when inflation increases. This is because gold is a finite resource, so its scarcity helps it maintain its value. 2. Portfolio diversification. Gold is not closely tied to other financial assets, such as stocks and bonds, so adding it to your portfolio can help diversify and balance out your investments. 3. Store of value. Unlike paper money, gold has a physical value and can be used as a store of value. This is why many people view it as a safe haven asset in times of economic uncertainty. Disadvantages: 1. Lack of dividends. Gold doesn't produce any dividends or interest payments, which means its return is solely based on changes in its market value. 2. Limited industrial use. Unlike other precious metals such as silver and platinum, gold has limited industrial use, so its value is largely driven by market speculation. 3. High storage costs. Physical gold must be stored safely and securely, which can be costly. It's important to factor in storage costs when considering an investment in gold. Overall, Warren Buffett's decision not to hold gold in his portfolio may be based on the belief that the disadvantages outweigh the advantages. While gold can offer benefits such as portfolio diversification and inflation hedging, its lack of dividends and high storage costs may make it less appealing as a long-term investment. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.